Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hi all, welcome to Business Line's State of the Economy podcast on commodities. One of the fastest developing sectors in the country is food services. It is estimated to surge around $150 billion by 2030. Currently, it is valued at $80 billion, and it has witnessed 11% CAGR over the past 6 years. However, it faces challenges in the form of commodity prices, particularly in agriculture. There are other factors such as inflation, currency movements, and oil that influence its fortune. To tell us more about the impact of commodity prices on the food services sector, we have with us Mr. Sanjay Kumar, CEO and MD, Rassense Private Limited. Welcome to Business Line State of the Economy podcast on commodities, Mr. Sanjay Kumar. You own one of India's largest domestically owned food service companies. Can you kindly tell us how a rise in commodity prices affects food prices?
Okay, you see, we cannot take a very broad view. I think what will be good is to take a segmented view because, when we talk about commodities, within the space of commodities, there are four key categories that we look upon as a business: vegetables, pulse and lentils, oils, and milk, dairy, and related products. Non-food items we will skip because I understand your focus is food. Now, as far as vegetables are concerned, we largely would say that our view remains neutral to somewhat inflationary, depending on how the monsoon plays out. Our expectation is that we'll see average monsoon this year, which means that on the vegetable prices front, we expect a subdued inflation, unlike last year when the inflation really spiked on vegetables. However, where the concern lies is on pulses and lentils. And on that, our view is that we could see a spike of between 12 to 14%. Now, I know this sounds very huge, but there are two pieces that drive this. One, that India is still largely dependent on imports for pulses. Okay. And to that extent, the depreciation in the rupee will have an impact on cost. And there is somehow one sector where our economy has not been able to step up is enhancing yields of pulses and lentils. And, it's kind of stagnated in that last 2 or 3 years. On edible oils, our view remains stable and we see good, yields there, and we're confident that it should be manageable in the range of 2 to 5%. Milk inflation over the last few quarters has moderated, but there are some supply side issues which we face in northern India, particularly in regions like around Delhi and Haryana and so on. So if you were to ask me on a consolidated basis, how do we see inflation impacting price of food, to your specific question, we think that it will be less intense than it was last year, but we do expect that there will be continued inflation, particularly driven through increase in cost of lentils and pulses.
Sir, you're talking about the prices of lentils and pulses. Currently, the global trend is bearish, with yellow peas being the villain of the piece. Yellow peas are ruling at $350 to $400 a ton. Again, chickpea prices are ruling below $700 a ton. Other pulses are also looking bearish. The government has allowed duty-free import of pigeon pea, yellow pea, and black mad pea. Won't this impact be felt in the prices of food?
That's a very good question. And let me explain why we're seeing what we are seeing right now and why this trend, if it continues, would be welcome. But the chances that it would remains, weak, particularly if you correlate it with the forecast on the price of the rupee. Okay. Because bear in mind that while there are reliefs being given for imports, most of this is because of the last few quarters, 2 quarters rather, where we've seen a relatively bearish trend, as you call it. I would say a flattish trend. Trend is, might be bearish, but the prices have remained flat. So going forward, what we are going to see is that, typically in the next 2 quarters, when inflation picks up, largely driven by the festive consumption, that you will one see some some upside on demand, which will of course also have an impact on pricing. But we also believe that the rupee will have a significant impact. Unless if the last 2 quarters, rupee has largely remained stable between 85 and 86. In fact, it has actually gained ground, which has helped in stabilizing commodity LOP prices. But if this trend were to be maintained, and this is anybody's guess, right? It's just a view that one can take. If you were to ask me that, Sanjay, can you bet 100% on this? My answer would be definitely no. This is an estimate, it's a view. Of course, we would be pleasantly surprised and happy if that view were to be wrong. But given what we've seen so far, there hasn't been a year where the prices of LOPs have ever come down. Okay, even in good years, leave alone the bad years. So what we believe is that it will be driven by the fact that consumption will grow, festive demand will sweep in, and at the same time there will be pressure on the rupee. All of which we believe will then come together in the next 2 quarters, and therefore we as a business need to be prepared for that.
And so on the edible oil front, that seems to be a bit tricky because we import nearly two-thirds of our demand from Malaysia, Indonesia, and the other countries that produce soybean oil. So what is happening is currently is we find that cooking oil is being diverted for fuel purpose. And what has happened is that has really lifted soybean oil prices like anything. They are up. They are the largest gainer among agri commodities this year. Palm oil is also reflecting or rather towing soybean oil prices. Now, how do you see this one affecting the food sector? One, and do you think it's wise to divert food for fuel? And that also means that where in India we are diverting rice for ethanol.
Well, if you see in percentage terms, it will not have an impact at a macro level. But having said that, you touched upon a very important issue, which is fuel itself, which we haven't talked about because we've limited ourselves to commodities. But if you would take oil as a commodity, right now the worldview is that oil is going to be remaining stable in spite of some of the challenges that we see in certain regions of the world. But that can swing either ways over the next 50 days. And if oil prices were to go up, then it will have a cascading impact on just about everything, including the logistics cost. Okay, and that's one of the things which we sometimes tend to overlook, is that inflation is not only driven by demand and supply of the commodity, but also by logistics and transportation. So where we see a challenge is that this piece of markets hate uncertainty. Inflation hates uncertainty because it gives rise to hoarding, and that's something no one likes. So we would hope that with the easing of the political turmoil that we see around the world, if that were to happen, then we believe that the points you mentioned around diverting for other purposes will kind of get offset by stable fuel prices. But should that not happen, then as you said, every one thing will lead to the other. If fuel prices shoot up, the need to divert food grains for this purpose will get enhanced, and that can only make it worse. Second, if fuel prices shoot up, then the cascading impact on the economy becomes huge, even for transfer of domestically produced food grains. Okay, so at this point, it's very difficult, and this is something that a lot of us within the organization are working on. Given the fact that we use SAP as our ERP, and we have about 7 years of data behind us, whether there can be some strong predictive analytics underpinning the items which we compose and then which we consume, sorry, and then see whether we can do some kind of a forecasting for key commodities, or edible oils being one of them. The second being, taking production data from the hinterland on pulses and lentils and forecasting likely imports, and then ensuring that how all of this can be built into a model to get some range in which we should see commodity prices moving. But that's the long and very long task. I'm sure within the next 2 years, such models will evolve. But till then, to your question about substitution and its, my view would be on a macro level, it may not impact much, but it would be driven largely by how we see fuel prices play out in the international arena. So there's a bit of a touch and go in that space.
Sir, currently inflation is at 6-year low. Is that helping food service companies in any way?
Actually, I could almost talk for a day on this, okay? Because there are two sides to this. Inflation is at a 6-year low is good news in the short term. But for a consumption-driven economy, one has to analyze it in a little broader context. Is inflation low because consumption is remaining flat, which means demand is not growing, and that concern does exist. You might be aware that India has one of the lowest per capita consumption of food. It's below even the lower level ASEAN countries. Now, if per capita consumption of food has to increase, which means our population starts becoming more healthy, then that demand will fuel inflation. But unfortunately, it is not increasing at the pace at which we would want it to in order to catch up with our immediate neighborhood, which is ASEAN. So the fact that food inflation is moderated has been more to do with the, demand, remaining flat rather than supply catching up to the increasing demand. So that's one. Especially, I'm only talking about food or nothing else. So the challenge is around how do we improve consumption behavior, across the rural areas where per capita consumption of food is still low. Now, if we do that, we will see a consequential impact on inflation. Inflation moderation, I think, has been driven more because of the fact that, there hasn't been a significant consumption spike. Other factors may correlate to that. Domestic savings are at an all-time low and household spends are coming down, all of which impact food consumption. It's the first casualty because, you know, almost the first casualty because for most households, it's one of the biggest expense items on their, home budget. So it's very difficult to take a view that it's purely a monetary policy outcome that inflation is moderate. It's, I think, a mix of various things. And if it so remains, even as food grain production goes up, then that conclusion would be more fair.
Sir, and one final question. How do imports impact food prices and how do you see the minimum support price system for key agricultural products?
You see, from a market perspective and a business perspective, one of the things which I think is very crucial is predictability. Now, the challenge we face both with imports and exports is it's very difficult to budget because you're not able to predict what the duty structure will be for each item in each category because we have a complex architecture around duties. And we have seen in the past that to balance supply versus demand, protect domestic producers of agriculture commodities, there have been introduction of levies or duties so that domestic demand is not impacted. Now, that while it is good in a sense, it protects domestic producers, it creates uncertainty. And the moment you have uncertainty in business, it impacts your risk appetite, which means the risk reward ratio is higher and you tend to be more cautious. So what would be good is if we see the duty structure remaining stable, having predictability, and hoping that we don't see spikes in the value of the rupee, it continues to hold. What is heartening is that in spite of RBI having dropped its repo rates in a historic decision a few months ago, we haven't seen a significant increase in inflation because with increased money supply, that would have been the expectation. Now, critics could argue that this is a signal of falling demand, but that's a wider issue, not so directly linked to commodities. But I would say that yes, to your question, that I remain optimistic that import duties will continue to be predictable and domestic production will continue to increase, albeit at lower pace than one would like. And overall, therefore, in the next 2 quarters, we expect on the food front a stable macroeconomic environment with just one red flag around LOP, which we discussed pretty much in detail. And honestly, you have more knowledge about this than I have. So I'm just giving you a layman's perspective to what I see from a business standpoint. Your analysis will be much sharper. It's much more detailed, as I heard you say, much more granular. So yeah, so it's been pleasure talking to you as well. And thank you so much for your time too.
Thank you very much, sir, for your very wonderful views. We hope our listeners would have benefited from this.
Thank you so much. Take care.
Until we meet in our next episode, this is Subramani Mancombu signing off. Bye.